Hey folks, thanks for joining me today. My name is Eric Wilkinson. You guys might recognize me from mainstream media, but what I'm here with Pro Trader Strategies doing is trying to teach you guys simple ways to learn options. I actually want to get to a point where you guys just understand options intuitively, and some of that has to do with just breaking down some of these nuances that we see in and around options and build on those from simple concepts and ultimately more complex strategies. But with this one, what we're going to be doing through this roadmap, if you guys have been following along, we have stocks in our portfolio. A lot of times what we're talking about with this roadmap is trading options just to take advantage of our directional assumptions. Now with this, we're going a little bit further and we're digging down onto that portfolio and building option strategies in these next couple of sections or next couple of webinars and building around that portfolio of stocks that we have in our possession or in our portfolio, for lack of a better phrase. Anyway, but protective puts can really help. I actually like protective puts better than using a stop. It seems like a lot of people like to use the stop because it's free. Well, it is free, kind of like Robinhood is free for trading. I'm not going to go into that, but the fact of the matter is sometimes when it's free, it really isn't that good. Okay. So, a stop you can get filled anywhere. The beauty in a protective put is exactly where your out would be. Okay. And we'll dig into that as we go along here. Let me get a couple of things out of the way real quick, though. Like I mentioned, my name's Eric Wilkinson. You do a lot of stuff on mainstream media where I've talked about the economic data, geopolitical environments, and how that impacts the markets. I actually started out trading in college, moved to Chicago right after graduating with a finance degree, jumped into the pits, and have been trading my own money ever since. So this is going to be our roadmap to trading options around the protective put. But most of the time with the roadmap, I'm like, let's put this on the shelf. Well, coming into this, we know we have an underlying or a stock in our portfolio that we want to put on some protection. And that's where we're going to dig into those nuances as we go through this. But first off, we need to talk about this roadmap road key in order to understand really what we're looking at when we're going into that option montage. Remember, I said I want you guys to know this stuff intuitively, and I've got some really easy ways to remember what these Greeks are actually doing. So delta we talk about is data. On the floor, we would say this is data because it gives us probabilities of being in the money, probabilities of being touched, all of those things. But what I want to do is really focus on how the delta affects our options premium in relation to that underlying move, okay? Because a lot of times people will just tell you to go out there and buy an out of the money put for protection. Well, for me, I like to do it a little bit different, and we're going to follow through as to why I think that my protective put strategy is a little bit better. All right, but first we need to know how delta affects our premiums. So when we're looking at this option montage, it can be anything. And I'm just going to say it's XYZ right now. And we're looking at the market on this underlying being right around 148.35, let's call it. So if the underlying moved up $1, so 148.35 is the last trade. So we'll say up by $1. So when we're talking about these Greeks, the Greeks all are going under the assumption that we're moving forward, we're moving higher, it's an advancement, all right? So that's the first thing that is something we need to understand. So when we're talking about delta, it is on the assumption the underlying is going to move higher. So when we're looking at delta on the calls and the puts over here, so we can see the calls here and the puts are over here, and this is the option montage with the strikes, okay? So when we're looking at delta specifically, and we have $1 move higher, right? So we moved higher by $1 exactly. We look at the option montage, and we can see down here on, let's just look at the 150 calls across. We can see that the delta is positive. So on this first dollar move higher, we would see this delta go into these premiums over here. So our premiums would increase from $3.60 to $4.05 on the offer or on the bid, and then this would increase by 45 cents as well. So we would look at this as being $4.20. That's on the first dollar. But we also need to think about the puts as well. So what happens over here on the puts? Well, on a first dollar move higher, these puts would lose money. You can see that the deltas on the puts are all negative. All right, we have a negative delta. That's because of the advancement, right? If the underlying moves higher, our premiums would decrease then by the corresponding delta. So we would be looking at $2.62 on the bid, and then $2.72 on the offer. So we would see these premiums on the put side decrease as the underlying goes higher. Now, think about it this way. If we have a negative move, a negative plus a negative, so if you have a negative plus a negative on the delta, then this would equal a positive 38 delta then, right? All right, so then if the underlying starts going down, and we went from 148 to 147 now, then if it was trading around 147.35, so we had moved down by $1, then that would be a positive delta. So we would have seen this delta go into there, and our bid offer would then have increased. So we would be looking at 338 and 348 at 48. I'll just go like that, right? So our bids would then increase in value as that underlying went down. And gamma, the easiest way to remember this is gamma goes with delta. All right, we talked about delta being dollar number one. This is on dollar number two. So on that second dollar move higher, gamma goes in to delta. So now we're talking about 150.35. All right. So 150.35, our gamma goes with delta. We can see the gamma line. I kind of covered it up right there. We're going to have gamma there and gamma here. But the gamma goes with delta. So then that would be 48 cents goes into these premiums, because this was the first dollar, right? These were the first dollar move. Now we have a second dollar move, and we have 48 cents going into these. So we would be looking at $4.53 on the bid and $4.68 on the offer. Okay, so gamma goes with delta on the second dollar. Now, if we looked at the gamma over here, we can see it's positive. That second dollar move, we would only lose 35 cents from here, right? Try and forget about that, but we got a positive gamma plus a negative delta. That would only have 35 cents now coming out of these premiums here on that second dollar move higher. All right, on the second dollar move lower, then gamma goes into that delta. All right, so gamma just goes with delta on the second dollar move is the easiest way to remember that. Delta is the first dollar, gamma goes with delta on the second dollar. And theta is just the thief. He's a thief in the night that comes and steals your premiums, okay? So every single night, we're going to see theta come in and kind of whittle away at our premiums. Sorry, I was trying to read a question over there. I thought it was a question. So you can see that theta is always negative. That means because tomorrow we wake up and if nothing else changed, the underlying didn't move, nothing else changed, we would see that we would lose 6 cents out of the premiums on both the calls and the puts. All right. Now, something to note about theta. Theta gets much more aggressive basically inside of 35 days to expiration. All of these will start ratcheting up, and he gets really aggressive, especially with just a couple of days left in the options montage. Now, further out, like way out in time, theta is not very aggressive. So start getting those levers and pulleys going. If you want to buy an option, where do you want to buy that option? Really close to expiration or really far away from expiration, just based on theta? That's right. Yes, you would want to go out in time. You want to limit that theta decay, okay? You don't want that erosion happening quickly when you bought something. And the way to limit that theta decay is to go further out on the option montage, or further out on days to expiration, further outside of, probably outside of 70 days to expiration is really the sweet wheelhouse for that. Inside of 35 days to expiration, you would want to be selling options, because then you got theta on your side. And there's a lot of other reasons, but those are some of the main brush points. All right. And Vega is just volatility. All right. And it's implied volatility. Okay. So implied volatility is across the board, and volatility affects our premiums in relation to how volatility reacts. So again, on the assumption we're moving higher, right? So if we move to 27.57, all right, so 1% increases by 1%. Just keep it all lockstep. We'll see that Vega is positive on both the calls and the puts. And that's because as volatility expands, premiums get pumped up. So if the interest, or the implied volatility, which is Vega, implied volatility, all right, increases by 1 percentage point, we would see that our premiums would increase by the corresponding theta, all right, or sorry, Vega. As Vega increase, or volatility increases, our premiums increase by that corresponding Vega. Now, something else to note with Vega. It affects further duration options more than the nearer duration options, okay? So, back to the levers and pulleys again. If you're thinking about buying and selling options, well, we talked about if you're buying it, you want to buy further out on the time horizon, right? And if volatility affects the further duration options more, well, then when we buy it and the volatility increases, that will help us out, okay? So, something to note also with Vega is it will ultimately tell us, implied volatility will ultimately tell us what these premiums are, if they're cheap or if they're expensive. And I'm going to drill down on that. That's some that we'll drill down on in detail. But volatility also tells us whether or not these premiums are cheap or expensive. Now, we can't just look at the numbers. We have to actually look at those numbers in relation to what this underlying is doing. All right. So we've come into the day and we're thinking, okay, I've got a couple of stocks. Jay was talking, he's got Nvidia with earnings around the corner, or whatever stock we're looking at in our portfolio. We're just a little bit worried about some downside if the market starts to correct in this, but we don't maybe want to get rid of, maybe you can't sell the stock because you got stock options, or maybe you don't want to sell it because of capital gains, but a protective put will allow you to lock in those profits at certain levels. All right, so basically where are we going? Well, we're looking at our underlying, and for me, I was going to look at this PIN example because I actually have PIN in my portfolio, and it has had a fantastic run to the upside. All right, so now I'm worried if it's maybe just gotten a little ahead of itself. I mean, this stock went basically from at one point where I bought it was super cheap, but into the 20s and 30s where it was trading before the pandemic, all the way shooting up to trading $130 just in a matter of months. Now, that should give anybody some type of pause, because it feels like there's probably an imminent correction happening, whether or not it's 30 points or 10 or 15 points. It doesn't matter. I feel like there is a correction coming, but I don't want to get out of this stock that I have lowered my cost basis to almost zero on and got at a really good level. So I want to leave that going, but I am staying mechanical with this underlying in my portfolio. I've done covered calls on it. I've lowered cost basis on it, but now I'm a little bit worried about locking in some gains, possibly making sure that I don't lose all of that upside. So obviously, if you're holding on to the stock, you're still bullish, but you're worried about the downside, right? I mean, if you were bearish in this underlying, you would just get out of it, I would hope anyway. But here is a situation where we don't want to get out of it because we're still bullish in this underlying. You know, if I were to build a case for PIN, you know, with all of the online gaming and everything else that's going on, PIN is prime for that. And they're in with Barstool Sports, which is just, I mean, just everywhere these days. So I am still bullish in my PIN. I'm still bullish in PIN, but I have a worry about a correction that I don't want to lose all my gains that I've seen. So I've got a worry about the downside, just to stick with the roadmap thought. All right. So the next thing we have to ask ourselves is, do we have a good destination? Well, when we're looking at taking a road trip and we're kind of heading cross country, now I ultimately believe that we're going to go north, but you know, I am worried about the downside. The idea here is when we're looking at a stock, say we're going to PIN, we need to make sure that there is a lot of open interest in wherever we're going, right? When we're looking at taking a trip, we're not just going to the middle of nowhere, unless I guess you're going to visit family or something like that. We aren't going to go in the middle of nowhere to the middle of a cornfield to take a vacation, generally speaking. Most of the time, we're going somewhere where there is a lot of interesting things to do or a lot of things going on, which is kind of like the correlation of open interest. There's a lot of eyeballs on the market. So if we are looking at trading a specific underlying, I want to look at the option Montage where it's as close to 35 days to expiration as one can get. All right. So what if we're following along with the whole roadmap analogy, then what we would want to do is look at our stocks, like I said, the ones that are close to, or our option Montage. In this particular case, we're looking at GLD. Any stock that is less than $100. So if it is less than, whoops, I want to get my pen. If it's less than $100, then basically what we're looking at here on our analogy is the roadmap sign, right, or a stoplight. So the idea is it's less than $100. It needs to be less than or equal to 10 cents. All right, in the option Montage. So when we're looking up here, we can see that there's 11, but this one's 6 cents, 4 cents between the two, 9 cents. So pretty much fits that rule. I would say that that is a green light. Now, if you get something where it's 2 times the rule, in this case, 2 times the rule would be, you know, equal to 20 cents. So it's got to be less than or equal to 20 cents. That would give me a yellow light, and a red light would be 3 times the rule. I would not really want to be trading options around an underlying where it's less than $100 and they're 30 cents wide. It's just, it just starts getting difficult. You'll give up a lot of edge to get in, a lot of edge to get out. You know, if you have to really feel like you need to put on protection around something that's going to have this red light, yeah, I would just be very cautious. I would, you know, incrementally bid it up from where the current bid is, just beat it by a penny, and then just cancel, replace, you know, about that quick. As long as it takes you to send it off, and by the time you go in, cancel, replace, and move your price up a little bit, maybe 1 or 2 pennies, in that time, it will give the algorithms enough time to find the best market for you and create a transaction. But that's generally the rule. What we're talking about when we're trading options is less than $100. it needs to be the option montage needs to be right around 10 cents or less to trade options around it. What do we do when the stock is over $100? Well, if the stock is greater than $100, so if we are greater than $100, then we just move the decimal. We move the decimal, all right? 3 ticks. 1, 2, 3. So in this case, we're at $210 stock. Well, then that would make it 21 cents. So you want to look at the option montage, make sure they're within 21 cents. You can see there's 10 cents, there's 20 cents. So it's fitting that rule. So along the analogy, we're looking at this as being a green light, right? That's a green light. Again, same thing, 2 times rule, yellow light, and 3 times. 3 times is going to be the, you don't really want to trade too many options around this. You're going to be doing a lot of price discovery on that. All right. So we moved the decimal 3 ticks, blah, blah, blah. We already checked that out. We're good to go. So, Visa, if we were trading that, would be something that would work as a good stock to trade options around. Now, in my case, I'm looking at PIN, right? We were looking at PIN for this. So I'm going to throw up there the 1, 2, 3. So I should be looking at 11.5 cents. Let's just call it 12 cents. In the option montage, closest to 35 days to expiration. Well, we can see this is a little bit wider. That one's 2 times or more than 2 times the rule. These are basically 2 times the rule. I'm going to give PIN a big yellow light. All right. We're going to have to do some price discovery on it. I have the underlying though, but I'm just knowing that if I've got this big yellow light going on, what I was saying is I would come in and probably bid 775 or over here, since we're talking about the puts, in here I would come in and bid $9.10 or something like that. Just get a little bit inside of that bid and then cancel, replace, move that bid a little bit higher. If I was trying to buy these 115 puts or the 110 puts or any of those, I would just, this would I'd probably go 670 bid, right? Just a little bit better than where the current is. I'm not going to go straight to the mid market. That might be the actual offer on a spread or something. So I'm going to stay away from any hidden, because anytime you guys are looking at this option montage, believe it or not, there's actually tighter markets going on that you aren't always seeing. So I always say it doesn't cost you anything to cancel, replace an order, right? It does cost you something if I came in here and just tried to lift this offer at 685. Boom, I'm getting 685, but I might have been able to get this a little bit better had I allowed the algorithms to do this auto leg of spreads, which happens, believe it or not. So as long as I give that enough time, and you only have to give them a couple of seconds before they have to figure it out. So that's why in that meantime, the cancel replace will allow you to get in there. So I'm saying this is a yellow light for PIN, but I do want some protection on this trade. What's the environment? Well, this is where I'm talking about volatility, implied volatility. When it's really low volatility, it's sunny skies, there's no stress. When there is high volatility, think about it as it is stressful. You're white knuckling it when you're driving, okay? So how do we tell if an underlying has high volatility or low volatility? Well, I told you implied volatility is going to tell us that. Well, they aren't all made equally. Let's just put it that way. So what we need to do is, you can see that I have a little chart down here for implied volatility, because this chart tells me when premiums are expensive or when they are cheap. Every underlying has its own implied volatility. We're not looking at the VIX to determine whether volatility is high or low. That will give us a good gauge of the broader markets, don't get me wrong, but it's not going to tell me if PIN has high volatility right now or not. So I need to determine for myself whether these premiums are expensive or whether they're cheap, because that's going to determine what kind of strategy I need to put on, all right? Now we know we're looking for protective puts, but I also don't want to buy puts when volatility is through the roof. I know that I am buying premiums that are exorbitantly expensive, right? So I want to buy cheap when I'm buying options. So when we're looking at this, I just kind of drew these lines in here to give me a ballpark. Well, I can see currently that this underlying, we can see that volatility usually has a pretty good set range here, all right? And another thing is, we had the pandemic. I want to discount all of this high volatility because I don't think that we're really going to see that volatility that we saw back in the day. I do think we're going to see some elevated volatility, more so than what we probably saw in 2019 for an extended period of time. So with that being said, I want to kind of get my data points from here forward. All right. So I just drew in these ranges because all stocks usually will have a pretty set finite range where their volatilities stay within. Tesla might be a little bit higher. Procter & Gamble is probably definitely lower than this on an average. Okay. So the idea though is that the underlying volatility is going to want to revert back to the mean. So when it's extremely low, it's going to migrate higher. And when it's extremely high, it's going to want to migrate out or back down. So we can see that volatility, just by ballparking it, is relatively low. And Thinkorswim for each stock symbol. Yes. Yes, Jay is saying that that implied volatility percent is in Thinkorswim, and it will give it to you. It will give it to you right down here. You can see current implied volatility percent for PIN is right around, this is saying 10 percentile here, all right? But, you got to remember that it is also taking into account this massive spike over here during the pandemic. And like I said, I'd like to discount, all of that happened there. So that I want to take out and look at the data from here forward. So if I want to look at that data from there forward, I need to know how Thinkorswim or any of these other platforms is coming up with that number. And I'm going to show you how to do that here in just a second. But we know we have low volatility. Why does the volatility matter? Because when volatility is cheap or volatility is low, we know that the premiums in the option montage are cheap. And when volatility goes up, we know those premiums are expensive. And on the flip side, when that volatility comes out, we know that those premiums are going to go down in value. The underlying doesn't even have to move. Now, remember, when we were talking about this earlier on, Vega tells us that 1 percentage point increase, right? We get, I think it was like 19 cents, right? Well, volatility moves in increments of like 2, 3, 5, sometimes even 10 ticks, all right? So 10 ticks on a 19 delta or on a 19 Vega, 19 cent Vega is $1.90. That's significant, right? And when you add in the contract multiplier of 100, right? Because every option contract has to be multiplied by 100 in order to get our pricing. That is very significant. All right. So when volatility is high, we sell premium. When volatility is low, that's when we're looking to buy premium. And we can see that this is relatively low. Like I said, Thinkorswim is going to add all of this in. If you guys want to really, I usually just ballpark it and say, all right, there's kind of mid-market. I can see that this is below 50. My rule for this is when we are less than, let's just go, if we are less than 50 percentile, all right, we're going to be looking to buy, all right? And when it's greater than 50 percentile, you're looking to sell options, all right? And you could, if you have a lower risk tolerance, you could say, all right, well, if it is less than 30, that's when you're going to buy. And when it's greater than 70, that's when I'm looking to sell, all right? So if you're newer to options, then you can definitely use this. Now, like I said, I want to take this out of the equation. So what we need to do is know how they come up with the math. And how they come up with the math is they take the current implied volatility, all right, minus the low implied volatility. You take that sum and divide it by the high IV minus the low IV. All right, so we've got our data points. We can see that this top right here comes across, and we're just going to say that that is, this is 100. I'm going to draw a line here and say that this is 70, okay? So now we have all our data points, right? Basically, what we're trying to do is figure out where this number is in relation to the range. So we're taking 76 minus the low, which is 70, and then we take that sum and divide it by the 100 minus 70. So we've got 6 divided by 30, which is going to give us 20%. 20 percentile. So it's still below 50, still within my range, even for a newer trader that has a lower risk tolerance. We know we're getting extremely cheap option premiums, all right? I mean, about as low as they're going to go. And remember when I was talking about we can see these things in a matter of 1 or 2 days drop. Look how much that dropped from basically, we could call it 95 all the way down to 75, right? So 20 percentage points, just from this day to this day, we could see that dropped almost 4 percentage points, okay? So that is significant. They move at a pretty decent clip. So we've got to keep an eye on our premiums to know whether we're buying them cheap or expensive. And we can tell by this that those premiums in the option montage for PIN are going to be cheap. So we're going to be looking to buy. We're good to go with this strategy. All right. What's the duration? Well, I mentioned this at the beginning. When you're buying an option, you want to limit that theta decay. All right. And we can see that show up on this type of chart here. So this is going to be the zone we're looking at outside of here, okay? I said 70 days is kind of that wheelhouse. We're going to kind of go outside of that. We can see why. Look at how much our premiums decrease inside of 35 days to expiration. That's pretty massive. A 50% drop in your premiums. You don't want to buy something and wake up 10 days later and have a 50% drop in it, right? Well, out here you can see that those are decaying much slower. So if we are buying, we want to be out here. If we're selling, we want to be inside of here. So we're buying a put. We want to get outside there. All right, so what vehicle do we use? Well, we talked about this. We're doing the protective put. All right, so where do we start? Well, if you go online, they're just going to say protective put. You buy an out of the money put. All right, now a protective put and a married put, if you're talking about a married put, the only difference between a married put and a protective put is a married put is implemented when you buy the stock. All right, a protective put is added on to your stock later. Well, an out of the money put doesn't really tell us anything. Well, a lot of people online will say you're going to use about a 36 delta. All right, and you can do that. If it's easier for you, that's fine. But for me, I like this further out of the money delta. Why? Well, it's a little bit cheaper, and I'll show you why. And it's a little bit more agile, or we can play I'm going to show you a way where we have a lot more room to be able to finesse this trade. Okay. So if we were looking at the option montage, a lot of people would come out and tell you that you're going to want to, let's do this. Let me do a couple of things here before so let's look at a couple of different ones. The 36 delta, all right? And I'm going to look at this somewhere between, like I said, that, 10 and 16 delta, all right? I usually kind of shoot for around right in the middle there, the 12 delta. Why? Because I like to do a multiple of these, like buy 3 of these 75 puts, whereas most of the time people are going to be buying 1 for every 100. If you owned 100 of the underlying, right? So let's say I'm long 100 pin, all right? So if I'm long 100 pin, an option contract is equivalent to 100 of the underlying. Now, you remember when I talked about the premiums, that when you go out here and buy this, you're not actually paying $18.50 or whatever. You're paying $1,850, okay, because of a contract multiplier of 100. That's because each strike is equivalent to 100 of the pin in this example. So I would rather go out the time horizon and buy 3 of these versus 1 of these. Now remember, delta, for every dollar move down, my premium is going to increase by this 36 cents, right? If I have a dollar move down, it's going to increase by 36 cents. This one on a dollar move down is going to increase only by 12 cents. But I've got 3 of them. So 3 times 12 equals 36, right? So for every dollar move down, I've created a situation where my premiums are going to increase just as much as that 110 strike, okay? Everybody following me there? You guys get that? I like this one and do multiple of them. Why? Because if this underlying starts taking off, I can peel off a couple of these puts when I have gotten long these. The other thing is if I'm correct, you know, this one only protects that 100 contracts that you have on. Well, ultimately, I can actually benefit from the underlying moving down because I have multiple contracts, right? Now, think about it this way. Also, if I bought 1 of these, you know, I basically paid $17, let's say, if I bought 1. Now, if I bought 3 of these, let's say it's right in the middle for, let's just say 410, right? So basically 3 times 410, I'm looking at $12.30. So here I had to pay 17. Here I'm only having to pay 3, and I still got the same type of move on the downside, right? And we're flexible. Underlying takes off to the upside, I start peeling these puts off. All right, I reduce my risk there. If the underlying takes off to the downside, I'm actually going to benefit more from my strategy here than I would from a normal, what they would tell you online to go out and do. It doesn't work out as well. So let's just look at it. If the underlying did move down, let's say $10, we get an underlying move down $10. And I've done this on the theoretical aspect. So if the underlying had moved down, again, we were looking at the 110. So we're going to still continue to look at those. We'll still look at the 75s. Actually, I wanted to draw that out a little bit further. So let me try and do that, cheat it. All right. So we can see that this went from $4. And like I said, I did the theoretical on this. All that happened was I moved it down by $10. So it's just throwing the price in there as if we were now trading at 106.19. All right. That's what this is saying. All right. So now if we move down, these would be in the money, right? Well, they went from basically, we're going to call it $17 again. What do we say? This one I'm going to say is 410. So $17. Now it's $21, let's call it. So $4, right? So basically $4. I'll just say $4 over here. And then this one is $1.40, let's call it. Right? That increased by $1.40. But remember, I have 3 of these. So this one increased by $4. That helps. Well, this one increased by $4 and what is that? $4.10 or $4. So $4.20. So, you know, that 20 cents doesn't seem like a big deal. Well, 20 cents is actually $20, right, with the option contract multiplier. So I've done better with this strategy by 20 cents or $20. I mean, if $20 doesn't make a difference to you guys, then just send it to me. I can help you out with that. And it gives me flexibility because let's just say the underlying came all the way down here and hit my 75 strike. Well, I could peel off a couple of these puts. I could take off 2 of them, lock in that profit, and I still have my 1 put left, right? That will protect me if this underlying goes to 0, okay? It's going to increase in value as it continues to go down, all right? And I really, at this point, wouldn't have any risk on the table because I would have paid off all of those other puts by implementing this strategy. All right, nice. With this strategy, do you own 100 shares? Would you consider selling a deep in the money call? No, I would not. You would benefit from the theta decay. I wouldn't do that because, when you're doing that deep in the money call, you're probably going to get the stock called away from you, right? With this one, it gives me a lot. I don't, and Jay is probably referring to the fact that he hates paying for options as much as I do. But in this case, really, this is the best case scenario to protect a long stock position in your portfolio. And yes, most people will tell you to go out there and buy about a 36 delta because the probabilities are pretty low. But if anything significant happens, you're protected. Well, same with this one, but this is more of a way to kind of trade it as well. It's more flexible. You're more agile with this strategy. You can play around with it a little bit more and benefit a lot, benefit monetarily by doing this, all right? So I think I showed you why I like to go out there and somewhere right between that 10 and 16 delta and do a multiple of them, all right? Usually I'll look at doing 2-3 times the amount of stock I own. So I own 100 here. So I'm basically doing 3 times 3 in the option montage. Okay. Which is usually right around that. I usually do about 3 for every 100 for every 100 that I have. All right. I don't like to do this because you're kind of beholden to it. If this underlying started going down, well, you can't really trade around it because you're worried about the downside. You can't really take it off for a profit in case it continues to go down. You're no longer protected. Well, with this one, we have that flexibility. We can take off 2 of them. We can profit from that and then continue to have no more risk to the downside. All right. All right, folks, I think you guys have got this. You guys are pretty savvy. So let's go back over this. On the protective put, the direction, we're worried about downside risk. Our destination when we're talking about that is the less than, 10 cents on the bid to the offer in the option montage, or you move the decimal, right? 1, 2, 3, okay? Move that decimal. All right. Environment. We want low volatility, but the fact of the matter is like Jay is talking about, he wants Nvidia. Well, it probably already has high volatility, but best case scenario is to do this when there's low volatility, because if that underlying does start taking off to the downside, usually that's when we see volatility start to spike. So we're going to get the best bang of everything, right? We're getting volatility expansion, directionality, right? We also have multiples on this, so we're kind of able to trade around our stock position, all right? So we want low volatility, but sometimes you just have to do it when you're nervous and you're going to have to pay up for it. Like, Jay, we're going to talk about this, that Nvidia, when you're buying that put for that earnings, know that when that volatility comes out, you might see this underlying start to move down, right? And you're going to have an uphill battle because as that volatility comes out of those premiums, it might offset the directional move. So if I'm doing this for an earnings, I'm going to try to do this well in advance, like a month or something. Yes, Volatility Crush. Jeff is all over it. The Volatility Crush, when you see volatility, heading into an earnings, do this. And then you got that earning event right here. and it goes, right? So this, that could be 20% drop. Well, that could be several dollars. That could be a $5 drop in those premiums for every one contract. If we're looking at 19 cents or something like that, that would be closer to $4, but still $4. And if you had, a 25 delta, that would be like an $8 move or something, right? Something like that. It would actually be a $16 move. Duration. We want long days to expiration. Days to expiration. I like to do the quarterlies. I also like to go outside of 70 days to expiration. 100 days is great. All right. Strikes. I do a multiple at somewhere between a 10 and a 16 delta. Okay. I don't go for that 36 delta on this trade. So our max profit is unlimited. The underlying can still go higher, right? That put we bought, we don't have to do anything. So it can continue to go up. But we do have to think about the purchase price of that stock plus the premium. All right. That is going to be something where our max, and then where when it's less than the current price, that's our profit on that. But when we're doing this, we also have to worry about, our max loss, we don't have to worry about purchase price plus the premium, and then all the way basically to the strike price of 0 is our, basically we won't lose our strike. Where the current underlying moves past our strike, we have no more risk below our strike. So there is no risk below that strike price. We're actually going to be synthetically stopped out there, but we don't have to get out of that. Like a stop, you wake up the next day, say your stop is at 100, you wake up the next day, the market opens up at 80, that stop's executed and filled at 80. The beauty in the options is if I bought 100 strike in this option, we wake up the next day and it's trading 80, well, I can synthetically get out at 100. Because I have as an option buyer, I have the right, but not the obligation to fulfill the contract. That means I have the right to put it to this guy, meaning I take my stock and I put it in his account, right? I have that opportunity. So there is a benefit as the underlying continues to go down below my strike. I can get out at that strike, but the beauty is it buys me some time, right? Like this underlying, maybe there was some bad news on the earnings and it dropped down, and all of a sudden they gave forward guidance that was absolutely incredible. Like all of a sudden in their earnings call, yeah, we missed on earnings. We did terrible but we found a cure for cancer. And all of a sudden this underlying blasts off to the upside. Well, you never got out, right? Because that you never took your right and fulfilled the contract, right? It gives you time to keep your powder dry. That's the beauty of it. And the break even is increased. That's what I was trying to get to way back here. When you buy a put, you have to keep in mind that your break even is now increased. So for instance, if I bought a stock at 50, it's trading 100 right now, but I bought it at 50, right? It's trading around 100. Let's say I buy the 75 put. I buy the 75 put for $3. Now, my break even on this stock that I bought at $50 is now $53. Okay? It's increasing the base. It's increasing what I had to pay for this underlying. You have to take that into account because a lot of people will want to go out there and buy puts every single time they get an opportunity. But you have to think to yourself, you want to do that when it is extreme or dire circumstances. If you're always worried about the downside in this underlying, I'd probably get out of it. But just keep in mind, if you continue to do this every single time these options expire, then you are paying a lot, and that is increasing your cost basis of what you paid for this underlying. So if all of this kind of confuses you a little bit, let me throw a diagram that might help some people out here with this here. So normally with a stock, we can see that this is our risk profile all the way to 0. If we buy the put, then we are limited to our downside. We can see that our risk profile to the downside is after subtracting the premium paid for that underlying. All right, so our break even, or our strike minus the premium, is that, right? But if the underlying goes below our strike price, then we have no more risk. But we do also have to think about what we paid for that. That's that difference there. Does that help out a little bit better? All right. So I think you guys have got this. One thing I always do is have like a notebook where I write all this stuff down so I stay mechanical, stay according to it. We're going to be buying. There's your offer. We're going to be buying a protective put. Right? So we're taking the protective put. On a winner, I'm going to ride it out. I already talked about how I'm going to trade that in and around that, but basically I'm looking to buy 3 times the puts. All right, actually I probably should be right at about a 10 delta, 10 to 16 delta. Right now, on the loss, I'm going to play this out. Meaning, on the loss of the protective puts, the underlying starts taking off. I am going to start taking off some of those puts all the way down to where I have a 1 lot if I'm still worried about the downside, okay? But I'm going to play around with that. And we're taking the protective puts, 10 to 16 delta. That's what we're looking at there, okay? If this underlying goes all the way down, I'm probably going to cover 2 of those puts when my strike gets hit. Okay, that's where I'll look to cover 2 of them when that strike gets hit. In our case, we were looking at around that, I think it was the 75 strike. If it goes down and hits 75, I'm covering 2 of those. I'm going to ride out that 1 put. If the market bounces off of that and takes off, then I'm just like happy as a pig in a puddle. So that's how we're going to play that. All right. Jay, I'll go over your example here in a second, but earnings with options, I'm going to throw a link over here in the chat window. We've been talking over there in the questions box over there in the chat window. You guys get a quick link to this. If you're watching on tape delay, you'll have to type this all into your URL. But basically, you get my entire catalog of earnings, basically all my best trades for earnings. We're in the middle of earnings right now, so take advantage of this. Also, I have trades setting up for the next earnings cycle. So after the earnings come out, you can automatically get mechanical and get involved in the next earnings, and I have strategies for that to take advantage of that type of situation. And you're going to be able to quickly spot the option strategies for those big moves, all right? And understand the probabilities, what strike locations specifically. I talk about the delta specific strike locations in this video. So if you hit on that link, it's going to take you to this page here, which also has the URL at the top. And for $36, seriously, you guys, that is like a 36-cent option strike price. All right, so $36. If you guys are watching the guys on TV talk about earnings trades and they're out there buying calls and buying puts, I'll tell you they are likely fighting a massive uphill battle, a Sisyphean task on trying to make money there. All right, thanks guys. Later webinars will go down on different option commitments, when and where I'll find those. Here's the link again. If you have any questions, comments, or ideas for future webinars, please reach out to us at 310-598-6677 or trading@protraderstrategies.com. All right, here is that link again, or that page. Please take advantage of that so that you guys don't make the mistake of listening to talking heads on TV talk about buying calls for strategies in earnings. All right. So how many hours of this is there's probably 15 hours that you can take advantage of for 36 bucks. Appreciate it, Jeff. Good to see you again. All right, so Jay, we'll go over that example really quick for Nvidia if anybody else wants to go through this with us. You can stick around. So let's look at the trade window and go to Nvidia. You can see in Penn, I do covered calls on all the stocks I own too. So trying to lower my cost basis to 0 in Penn, and I'm very close. All right. So, and Penn doesn't pay a dividend. So, doing covered call strategies, I get a free dividend. I can look at it that way. All right. So I'm going to be looking at Nvidia, and it's a $600 stock. Move the decimal 3 ticks to the left, 60 cents. We want to look down during open market operations. Excuse me. You can see that it's a little bit wider than that right now, but I can tell you Nvidia usually does fall very close to within that 60-cent rule for itself. So let's just say that we got that. It's working out in our favor. It's 60 cents or less. So I'm going to go out here. I like the June. Why? Because that, like I said, is a quarterly. There's usually a little bit more when you get way out in time, a little bit more volume around those quarterlies. So if you're trying to decide between May or June, I would go to the June only because there's probably more participation in there. Markets will likely be a little bit tighter. So that's what I would look at. I'm going to go and stretch this out to all of them so we can look at the comparison between these two on the deltas. So we're looking at the, let me pull this up so I can just draw boxes for people that they can see it a little bit early or easier. So let's look at this 37 delta, right? $49. Let's go to my 16-ish delta. Actually, since I'm doing that one, I'm going to go and I'm going to look at the 12 delta again, just so that I can compare it a little bit easier, right? It's easier to multiply 3 times. So 3 times, let's call it right in the middle and say it's $12 right in the middle just for math. And let's just say that this one's $49, pretty close to being right in the middle there. So 3 times this, we're looking at $36 versus $49 if I bought one of these versus buying 3 of these. A little bit cheaper. 3 times this delta, 36. Yeah, I'm losing a penny or $1 for every $1 that comes down. I don't care that much about that. As the underlying goes down, you can see you can multiply the volatility times 3 as well. So it's only, you could say, well, it's only going to increase by 69 cents. Well, it's times 3. Remember, I got 3 of them versus this one. So even the volatility for every 1 percentage point increase, you can see that that is more beneficial. So if I get that volatility expansion, that will help. Volatility contraction, Jay, will hurt in this strategy heading into that earnings, okay? Remember, volatility affects those further duration ones. So this could hurt on a move to the downside. That volatility contraction crush coming out of this premium, we could see that directional move happening, and 20 percentage points is very significant when we're talking about 69 cents or even $1.20 on that, all right? So going into an earnings this late in the game, you're going to see that the premiums are pretty jacked up already. You can see that the premiums are pretty high. And if it drops down to here, you can see that that is close to 10 percentage points, right? So you're going to lose like, a significant amount of money, 10 percentage points times your strikes that we were looking at. 10 times the 128, that's 128, right? Or actually $12 to come out of that, right? All right, so we don't want to see that happen. So Jen, I would just say probably, setting this strategy up for earnings, you probably would have wanted to do it, several days ago, like 15, 20 days in advance rather than less than, what is it, on the 24th? You're less than 7 days, really. Okay. The premium might increase a little bit heading into it, but it's a little bit worried. With earnings in Nvidia 224, would you buy puts after the earnings next week? What I would do for after the earnings, if I was worried about it, I would do one of these like a put diagonal, long put diagonal, which I just did last week. I would do something like that where I would sell the put a little bit closer, maybe buy the put further out, try and get some play there for those earnings. That makes sense. But I probably would have done the puts, think about that. If you would have gotten that 10 percentage point increase had you bought them back here, you're probably still looking at around the same strikes even. Okay. All right, that's all I got for you folks. I hope everybody has a good one. If you have any questions, comments, or anything else, like I said, reach out to us at protraderstrategies.com, 310-598-6677. All right, take care of you all. Have a good one. Bye for now.